So, the nightmare for most investors is that they buy a property believing it will appreciate in cash flow, and it does neither. What if a client you were helping had the same problem and called you in a panic? What would you tell her? Is there still a way she can make money on it? Stay tuned, and we're going to find out together. Hey, it's Russ from the Neon Bros, bringing you the best in financial literacy so you can educate your clients and sell more houses. That's the whole point. If this kind of information gives you an advantage over other agents, please like this video and subscribe to our channel to get more ideas like this one. We all know that real estate offers advantages that other investments just don't. But what exactly are those advantages, and can we isolate and quantify them to see how much excess benefit it really offers and then explain it to a client? You bet we can. The best way is to completely remove cash flow and growth from the picture and see how much we're left with. Let's take a look at a reasonable example. I'm going to share my screen now, but before I do, let's hear a word from today's sponsor, my own avatar.
Successful real estate agents know one thing: you're only as strong as your pipeline, but keeping it full shouldn't feel like a grind. Cold calls, awkward networking events, and endless mailers might get your name out there, but they drain your time, energy, and enthusiasm. That's why we built Opportunities Everywhere, a smarter, easier way to attract clients you actually enjoy working with. Instead of chasing leads, our system creates them for you. Using a library of short, engaging 10-minute videos, it quietly teaches everyday people how and why to invest in residential real estate. Then, when they're ready to act, they come straight to you. The best part? These aren't just one-time buyers. They're future investors you've shaped from the start, clients who understand your approach, trust your guidance, and keep coming back for their next purchase. If you're ready to fill your pipeline with the kind of clients you've always wanted, visit opportunitieseverywhere.com to learn how.
So in this example, we're going to assume that the cash flows are merely break even and the appreciation is zero. So notice I'm not saying that the cash flows are negative and the property is decreasing in value, because that would just be a bad investment. We're not looking, for bad deals. We're actually looking for decent deals. But what we're trying to do is we're trying to just reassure a potentially scared prospect that a deal that might have hit a snag can still be salvaged. So here's how it works. In this example, we're going to assume that the purchase price of the home is $175,000. The down payment is 20%, which comes out to $35,000. And then that leaves a mortgage of $140,000. Closing costs are 4%, just kind of a rule of thumb. So we'll just say that that comes to $7,000. And we're leaving cash reserves of about $5,000 just to have some information and just to have some reserves available in case we have some repairs to do, or just to make the owner feel a little bit more comfortable knowing there's some money in the bank. So what that means is that the total cash invested is $47,000 out of pocket. So the first advantage that you have to recognize is depreciation. So we're going to assume it's straight line depreciation over 27 and a half years, and that the assessed building value is $110,000 in this example. So that leaves total depreciation of $4,000 per year, which is $110,000 divided by 27 and a half. And at a 20% assumed effective tax bracket, and actually we get to that down here, but we're assuming that the tax bracket is of the investor is 20%. So that means that his actual savings, his tax savings, is $800. That's $4,000 at 20% is 800. So that means that the return from depreciation is 1.7%, which is $800 divided by the initial amount that he put into this, or she put into it, is 47,000. So 800 divided by 47,000 is 1.7. Well, that's not a great return, so we're going to keep going. We're going to assume that the interest rate on the loan is 8%. That, maybe this was from a few months ago when things were a little bit higher than they are right now. And on that $140,000 loan, we're going to see what happens now below. So the second advantage is that there's the mortgage, the loan pay down, the mortgage pay down. So each month as the mortgage is being paid off, part of the payment goes to principal and part goes to interest. So the principal part of it in year one is $1,068, which means that the new equity gained is also 1,068. So if we add the 1,068 to the 800 from part one, we come up with 1,868, and then divide that by $47,000. That comes to a running total return of about 3.97%. So we're getting up to about the rate of, like a CD at this point. But now where it kind of separates itself is now if we add this third benefit, which is the mortgage interest write-off. And again, with this person, it's interest paid is 10,232, and I'm just getting this from a mortgage calculator running 8% at $140,000. So 10,232 with a 20% effective tax bracket that this investor is supposedly in, comes out to an actual tax savings of $2,046. So if we add the 2,046 to the 1,068 to the 800, we come up with $3,914. If we divide that 3,914 divided by 47,000, we come up with a grand total of 8.33. And that's separate from cash flow and separate from appreciation. So without doing anything, without having any benefit of the real um, desires that most investors have, they're starting off with 8.33, and anything after that is gravy. 8.33 is a pretty solid investment. Not that this is coming back to you in the form of cash, but it's in the form of savings and in the form of wealth creation for the investor. So the main takeaway is that whether there's cash flow and appreciation or not, this property will benefit your investor by 8.33% no matter what. 8.33% is banked and can be added to whatever cash flow or appreciation may come now or in the future. This is the baseline benefit that happens every year as long as she pays the mortgage. If you're finding this video helpful, please like it and subscribe to our channel. It really helps YouTube spread our information to others who may also find it helpful. But back to our example. It won't always be 8.33%. That will depend on the price of the home, the tax bracket of the investor, the interest rate, the length of the mortgage, and the assessed value of the building, among other factors. But whatever the tax benefits and mortgage paydown numbers calculate to will happen each year. She never needs to worry that she won't get them. They are all a structural part of all real estate investments, unlike cash flow and appreciation, which are specific to a property and are not guaranteed to happen. The tax and mortgage paydown advantages provide built-in elements of wealth creation for any property for which she pays her monthly mortgage. If there is any cash flow or appreciation, it will just get added to the 8.33% to make the investment all that much better. But 8.33% is a pretty good starting point for any investment. This is why when stockbrokers compare the long-term stock market average of around 11% to the real estate averages of about 5%, it looks so compelling in favor of stocks. But the 5% that they're quoting is only the appreciation. They curiously omit the 8.33% or any potential cash flow, which combined typically make real estate a compelling choice, probably because stockbrokers don't sell real estate. But you do, and I hope this information helps you sell a lot more of it. Please let us know in the comments section below if you have any questions or if you get any results when presenting these ideas. Until next time, I'm Russ from the Neon Bros, wishing you and your clients a lot of real estate success.